GDP has surpassed all expectations. It has come in at 7.8% for the fourth quarter of FY24. And here it is to be noted that the figure surpassed the RBI's estimate, which was 7%, according to the projections that were made in its April monetary policy review that the RBI put out. And the full year, the FY24 GDP has been revised upwards, and that number is 8.2%. It has been revised from the second advance estimate of 7.6%. And the real GVA, now that has been estimated to grow by 6.3% in the fourth quarter of FY24. Ahead of these numbers coming through, not too long ago, here at ET Now, we had a chance to get a one-on-one interview with the RBI Governor, Shaktikanta Das, and he sounded pretty confident about GDP and how it would pan out for FY24, and he did mention that it would be very close to 8%. Listen into what he told us.
To say that there is every possibility of the 7.6% growth for the current year being exceeded. I think there is quite a good chance of the growth GDP number for the current year being very close to 8%. Now coming to next year, we have given a growth projection of 7%. Other forecasters, including international agencies, have given much lower projections for next year. For next year, we stick to 7%.
Let's get your perspective on this because, yes, we are hearing from the Finance Ministry as well and several factions within the ministry speaking to us and talking to media people, the factors that have led to the strong growth this time around. My colleague Prakash Priyadarshi is right over there in Delhi, bringing us the latest updates. Prakash, what are you hearing from the corridors of the Finance Ministry about the reasons why we are seeing strong growth?
Yes, it's a positive development for the Indian economy where it seems to be growing provisionally at 8.2% in the financial year 2024, and that these numbers also shows that the Indian economy was fastest growing economy during financial year 2024. Sources are informing that the rural demand has picked up as compared to urban demand. Sufficient availability of fertilizer, including increased sales of tractor, have maintained the momentum of the rural economy going forward. Along with that, sources are also informing that the growth prospects appears to be bright for the Indian economy, though external factors pose a downside risk going forward. When it comes to credit growth, sources are informing that the credit growth seems to be an upward trajectory. Domestic economic activities remains resilient. And when it comes to fertilizer, agriculture growth, sources are informing that the fertilizer growth seems to be higher in financial year 2025 as compared to FY24. Along with that, when it comes to export, sources are informing that the strategic trade agreements like the India EFTA trade partnership shows India's commitment to expanding its global trade footprint going forward. When it comes to risk factor associated with the Indian economy going forward, sources are indicating that the geopolitical tensions pose downside risk to the Indian economy. Divergence of monetary easing paths of major central banks add to policy uncertainty. Along with that, the food prices are something which may pose a risk to the Indian economy at international food prices and domestic food prices as well. But the government and RBI are taking collective efforts in order to mitigate the risk to the Indian economy. In addition to that, sources are also indicating that the elevated financial markets valuations globally, particularly in the US, may have spillover impact on the Indian economy going forward. Last but not the least, the sources are indicating that the impact on sentiments and the household finance due to rising retail exposure to the stocks through F&O is something which is one of the major risk factors associated with the Indian economy that needs to be addressed.
I know that there are briefings that are still on, and if possible, I would request you to stay on in this discussion that we are having with the economists as well. Let me bring them in. Rajani Sinha is the chief economist at CareEdge Group, and Devendra Pant is chief economist at India Ratings. Thank you both for joining us on this edition of the show to discuss GDP, its growth, and whether or not it's going to sustain now that we've seen FY24 getting reported at 8.2%. Rajani Sinha, how do you read into this jump, the kind that we're seeing in the fourth quarter and an overall for the financial year 2024, it has surpassed the RBI's estimates as well. And we heard what the RBI governor had told us. There was an expectation that we would do well on the GDP front. But do you believe that the RBI, after looking at these numbers, is going to wait until the end of 2024 to start cutting rates, as you've articulated earlier this year?
Vikram, the high frequency indicators that we had been getting for Indian economy been very good, be it PMI manufacturing, PMI services, credit demand, auto sales, GST collection. So we were optimistic on growth. Nevertheless, I would say this 8.2% growth number that has come has been higher than our expectations and most of the market participants' expectations. The important thing to highlight here is that, interestingly, the GVA growth that has come for the fourth quarter at 6.3% is broadly in line with our expectations. What has really pushed up the GDP growth rate is, one, that the GVA growth for the previous quarters have been revised upwards, specifically for the third quarter. And secondly, what has given a push to the overall GDP growth is that this divergence between GDP and GVA that we had seen in the third quarter has continued in the fourth quarter, which basically means that there has been strong jump of around 22% in net taxes because of high gross tax collections and lower subsidies. So that gets added to the GVA growth rate, and that's how we arrive at the GDP growth rate. So that's another factor that has given a big push, because of which we have got this GDP growth rate of 8.2%. But otherwise, for the fourth quarter, if I look at the sectoral growth rate, it was broadly in line with expectations, with agri growth being feeble as was expected because of poor monsoon. Industrial sector growth, manufacturing specifically, there has been some deceleration, but broadly it's a healthy growth. And so has been the case with the construction and services sector that have recorded good growth. Now, one thing I would like to highlight is that one concerning aspect is that consumption growth has remained feeble in the fourth quarter.
Right. And that's going to be a concerning factor going ahead. If you look at the demand situation and perhaps the disparity between urban and rural demand, Mr. Pant, away from the technical part of looking at the GDP numbers, for people, a common man, how is this reflecting in his or her ability to really meet the kind of needs that we have at this stage, the prices at which those needs are getting fulfilled, the kind of inflation that we are seeing, and the kind of demand that we have as an economy, even if you keep aside global demand?
Look, Vikram, we have to first decide who the common man is. Are we three people on the screen right now represent the common man? I think we represent top 5% or top 10%, if not top 5%. Now, if you look at problem with aggregate number and you start dissecting it, not going into what all Rajani has said, like I fully endorse what she has said. If you look at the food inflation, as you rightly said, has remained very high. And if you look at what the bottom 50% of the population, I'm not going down to bottom 10% or bottom 20%. Bottom 50% of the population feels a higher inflation compared to the average. When I'm saying average, it's based on headline inflation. And that is what is happening. And that's why we are seeing the consumption growth, which in the third quarter and fourth quarter, with 8.6 and 7.8% GDP growth, the consumption growth has remained 4%. It's the largest component. The problem is, if you look at the corporate sector salaries, they are growing much faster. If you look at the salaries of the people at the bottom of the pyramid, whether we say the agriculture laboral or urban or the rural non-agriculture wages or the low-end wages in the urban area, they are not growing that fast. At times, the real wage growth is negative. Now, our analysis shows that if there is a 1 percentage point increase in the real wage growth, that will translate somewhere around 108 to 110 basis point increase in PFCE or the consumption growth, or close to 60 basis point in real GDP growth. So basically, if the inflation goes down just by 1 percentage point, say from 5.5 to 4.5, that will give a lot of benefit, and that is going to give increase in the demand.
Right.
People are talking about revival in rural growth.
Yes.
When we are seeing the real wages in the rural areas are not growing, we are seeing the real the agriculture growth is not that great. 0.5% real GDP, real GBA growth in agriculture can't be termed as good growth.
Right.
Now, it is difficult to say as of now. Talk to any FMCG company.
Right.
They are still looking at where the demand is.
Correct.
So it will take a while. It will take a while before if the inflation continue its downward trajectory.
Yes.
It remains around 4.5 percentage point. Then we may see some rural demand coming in.
Fair
Otherwise, as on today,
there is that disparity. But let me take that across to my colleague Prakash, who's been talking to his sources within the finance ministry. When you talk about revival in rural demand, Prakash, when you talk about the kind of demand-supply situation as it exists, because economic activity, like you pointed out, has been resilient, is what you're picking up from your sources. But when you look at the kind of growth in consumption levels, what exactly are they saying?
Yes, what we are learning from our finance ministry sources or the government sources, they are very much optimistic about the growth trajectory of the Indian economy. It's rare that we are seeing the growth in rural economy is higher than the urban economy, which is a positive factor of the overall story. Along with that, as per the government estimate, growth consumption, domestic consumption is even going to be up in financial year 2025 as compared to 2024. Along with that, how the government is optimistic about the Indian economy, we can simply understand by the statement which have been issued by the Prime Minister and Finance Minister themselves. Along with that, the government is very much optimistic about the growth trajectory that the Indian economy has shown in terms of domestic consumption. But when it comes to external factor, these are the major concern for the Indian government and the Indian economy. Because the maximum risk we are facing at this point of time is coming from the external factors, be it supply side disruption coming from the Red Sea area where the freight charges have gone many folds. Along with that, we have 3 wars going on simultaneously in different parts of the country. Crude prices, however, it is under control at this point of time, but we are not sure as to how long the prices will be under control, and we are largely dependent on imports. So these are the major factors which are causing risk to the Indian economy, and the government is very much aware. And that would be very interesting to see as to how government is going to control this situation, mitigate these risk factors going forward. But at this point of time, government is very much optimistic about the growth trajectory of the Indian economy.
Now, do weigh in on what my colleague Prakash is pointing out, that the risk factors are broadly more external than internal. Would you agree with that analysis from an economist standpoint today? And if you look at the further trajectory, looking at the 8.2% number, do you think that can be sustained even if you're going to bank most on domestic demand?
So, Vikram, we are expecting a growth of around 7% for FY25. I think on the domestic front, the most critical aspect would be for the consumption to improve. And here what we are talking about is a broad-based improvement in consumption. Because if you look at the higher income category, they are spending, and that is getting reflected in, impressive sales of higher price point items, say luxury cars or high-end housing. We are seeing a strong demand there. But here what I'm talking about is a broad-based improvement in consumption. And that would be a very critical factor going forward from domestic perspective. Because it's only then when the consumption growth is, revival happens and it's sustained, only then can we expect an improvement in private investment cycle. And here, I think the consumption recovery would depend on a couple of factors. One would definitely be, like we've been discussing, food inflation coming down, because that's an aspect which has a strong bearing on the spending power specifically of the lower income category. So food inflation coming down would be a critical aspect. We are, given that we are expecting a normal monsoon, that should be good for rural demand, and there should be some improvement in consumption as long as the monsoon, the spatial distribution and temporal distribution, those factors are taken care of. On that aspect, there could be some improvement in consumption.
Right.
But the other critical aspect would be what happens to inflation. Then the bigger question of employment opportunities.
Correct.
That's another thing which would have a strong bearing on consumer sentiments and consumer spending in FY25.
Talking about spending, as far as capex is concerned, the heavy lifting, Mr. Pant, has been done by the government in the recent past. Private capex has still been lagging in a large way. Looking ahead at the formation of the next government, the presentation of the budget in Parliament for FY25, how do you think that's going to pan out? Because, yes, we've got this huge check that has been written out by the RBI by way of a dividend payout. Is that going to help the cause of further government spending?
Look, the government spending has to stop at some point of time, because we are looking at, government should not be at every place, but at time when the going was tough, there was no demand, government has done its part. We have seen certain pockets where the revival, private capex revival is taking place, mainly in the infrastructure and some other sectors. But until unless the demand improves, we are looking at full year 4% consumption growth, third quarter, fourth quarter, 4% consumption growth. Until unless that consumption growth revive, it is unlikely to see the broad-based investment revival. So the consumption growth is key. Consumption growth is crucial. Coming to the budget, the kind of growth trajectory we had seen, it has surprised everyone. If I say no, it was as per our expectation, we believe, I'll be lying, right? I don't think you talk to anybody, any economist, any forecaster, none of them were at 8.2%. You look at
exactly
before 7.3% number came.
Yes.
Before first advance estimate, all forecasters were at 7. The dilemma forecaster.
Correct.
30th January 7.3, 31st May 8.2.
Correct.
The kind of volatility. Now, what is going to happen in the budget? Look, 2.1 lakh crore kind of dividend.
Yes.
And the trajectory of the growth momentum. Yes, inflation will go down. The nominal, the deflator growth will slow down. You will see, but you are still going to see somewhere around, instead of 10.5, which was assumed in interim budget, we may see a nominal growth projection of somewhere around 11%.
Right.
Now, what that additional 1 lakh crore gives to the government is either if there is any unforeseen expenditure, they can do it.
Correct.
Or based on the number of GDP today and the numbers for the fiscal 24, the fiscal deficit instead of 5.8% is 5.6% in FY24. So if there is no unforeseen expenditure, instead of 5.1, government may go down to 5% as the fiscal deficit number for FY25, and that will lead to journey to the 4.5. Mind you, this 4.5 is different from earlier 3%.
Correct. Right. No, but even if it is that trajectory, even if the fiscal deficit, there is more maneuverability where the government is concerned, and let me take that across to Prakash, in terms of managing the fisc, is there that much more power that the government has, looking at the kind of GDP numbers it has, and the kind of coffers that have been filled with the RBI payout, with the kind of revenues generated through the FY24? What have you heard about the fiscal deficit and the kind of targets that may be set? Prakash.
Yes, what we are learning from our government sources is that it sees that overall capital expenditure, the quality of capital expenditure has improved with the government increasing capex throughout the years, in last 2-3 years, and which is around 11 lakh crore at this point of time. and there is expectation that the government may increase capital expenditure target going forward. But my point is here, now coming on to your point, that what the government roadmap in order to maintain its fiscal planning, we are getting from our sources that it is very much confident to achieve 5.1% fiscal deficit target by the year 2026. And we have, increased collection at GST front, record direct taxes collection, along with that the additional dividend coming from the RBI. The government is pretty sure that it will achieve 5.1% fiscal deficit target. Along with that, the way there is a positive sign that the private investments are now returning to the sector. There is a additional growth in banking credit. Along with that, the government is also expecting that with the expansion of rural economy, the consumption will return from urban sector to rural sector as well. So all this, all in all, the government is very much optimistic about the prospect of the Indian economy on back of a strong domestic consumption. And the way capital expenditure targets are being revised, private investments are coming in, banking credits are growing, the government is very much optimistic to ensure that the current growth target may sustain going forward.
Will it be sustained? And that's the important question in terms of the ability of the government to manage the fisc. Rajani Sinha, where are your expectations pegged? Because we're looking ahead at the budget, we're looking at that much more spending. Is that likely to come in? Of course, it's expected that infrastructure is going to lead sectoral growth if it's the government that is spending. But what about manufacturing? Considering the contribution of manufacturing to these GDP numbers, looking at the risks to growth, AI has been mentioned as well. Looking at the possibility of services sector not contributing as much in the future, which are the sectors that you think are going to help sustain this kind of growth that we are talking about? Rajani Sinha.
So the critical aspect would be, I think, for the services sector to continue being the engine of growth for Indian economy. What we have been seeing is that some of the sectors like trade, hotel, tourism, those sectors have been doing very well. They have done very well in FY24. And I think that momentum is going to be maintained in FY25, though there could be some moderation because of some waning of pent-up demand in FY25 when it comes to this particular segment of hotel and tourism. But broadly, I feel that sector will remain strong in FY25 too. Financial services, real estate, I think those sectors will also continue to continue recording good growth. So I remain optimistic on those sectors too. So broadly, I feel services sector will remain strong. In manufacturing, some of the sectors that will support growth would be sectors like steel, cement, auto ancillary. But for manufacturing sector, one thing that we need to be cautious of is that we are seeing commodity prices going up, specifically industrial metal prices. So if that trend continues, the manufacturing sector could be looking at higher input prices in FY25. So that's something which we need to be wary of. And as far as agriculture sector is concerned, the growth was very weak in FY24. But in FY25, if we have a normal monsoon with a good distribution, we could see better agricultural growth too. So to answer in a nutshell, I would say it will continue to be the services sector that will be the engine of growth for the economy.
Talking about engines of growth, the RBI needs to do that balancing act between maintaining growth and controlling inflation and higher prices. Mr. Pant, as far as interest rates go, looking at this kind of number, the RBI, how do you think it's going to play out the rate cuts in the future? Where do you expect them to start, looking at this kind of growth that has come through today?
8.2% growth. Do you need a rate cut?
Exactly.
So there may be, earlier we were expecting, like the market was saying in the first quarter, we were saying that maybe if at all it will happen in the second half. With such a strong growth number, it is very unlikely that there will be any rate cut in this calendar year or in this particular fiscal year. We are already RBI is very watchful of the retail loans, and yes, if the consumption demand revives and there is a participation of the private sector, across the board participation, we may see some steps by the RBI somewhere whereby they are talking may ease the liquidity in the system. But the biggest problem with the RBI in the liquidity management is, apart from everything else, is when and how much government is going to spend. If government is continue to have 2 lakh crore or 1.75 lakh crore or 3 lakh crore kind of surplus with the RBI, they don't have any other option but to go for the auction of that, because that money is piled up is not with the banking system. That money remains with the RBI. If government smoothens its expenditure pattern over the years, and that will ease out some of the liquidity pressure on banking sector.
Yes.
Because RBI at the end of the day will look at like whether the call money rates are moving in the last corridor,
Exactly.
whether liquidity is in plus minus 1% of NDTL. These are the two guiding principles by which
Yes.
they operated. But unlikely that any major monetary policy changes
Correct.
in FY25.
Right, fair enough. Like you correctly pointed out at the start of that answer, at this kind of growth rate of 8.2%, whether or not we sustain it is one part of it. But looking at this number in itself, how soon would we require those interest rate cuts to come through is a good question to ask. It's a monitorable that we will be doing very closely. But of course, looking at this number, there is great hope pegged on further growth of the Indian economy, notwithstanding the risk factors which we discussed are more external than internal, but demand is growing, and that gives us the hope that we are going to see sustained growth in the GDP numbers. Rajani Sinha, Devendra Pant, my colleague Prakash, thank you very much for joining us on this discussion here on India Tonight, looking at the GDP numbers and its sustenance. Meanwhile,
if you like this video, then like, share and subscribe to ET Now.